All right, let's go.
Hi, Alex.
Hi, Roman.
So, shall we discuss today why options are much better than futures and the spot market and offer many more opportunities?
Of course.
Did you know that 95% of traders lose all their money in the first month, especially those who trade futures?
No way. I've heard about that. I didn't know that.
And those who trade with leverage, especially with more than 20 times leverage, lose their money within the first 10 hours.
Oh, all right. Started fast, finished suffering fast.
And today I'll show you how you can trade with huge risk using options. And at the same time, if you really want to make good money starting with a small amount of capital, I'll show you how to use the same leverage, but without the risk of liquidation. And you can earn not only from rising and falling markets, but also from sideways markets, from slightly rising or slightly falling markets, and so on. In other words, these are completely new opportunities. So the main points are, first, that you can earn money starting with a small amount of capital. Second, there are no risks of liquidation, and you can always clearly know your profits and losses. And I suggest that instead of empty talk, we demonstrate this using an option simulator because practice is always better than theory. All right, open the option simulator.
You've got me intrigued. Tell me about it.
Look, this is the option simulator. And in this option simulator, we have a great opportunity to compare regular linear instruments such as spot and futures and accordingly options. And as you can see, in the options simulator, you have buttons for long short, buy call, buy put, sell call, sell put, and buy straddle, sell straddle. And accordingly, these buttons will allow us to very quickly understand what the advantages of options are. To start, let's discuss what opportunities a person has when trading on the spot market. Press the long button.
Yes.
And look, here we have it. Your profitability chart is reflected here. That is, if the price goes down, it turns out that there will be losses. If the price goes up, you will make money. So it turns out that someone trading spot needs a rising market, because if there is no bull market in the portfolio, there will be losses. It turns out there is only one way to trade. In principle, it's not bad for long-term investing, but unfortunately, it doesn't work for making more precise forecasts and accordingly earning something from that. Well, you can, for example, press the next button a few times, and you'll see that if the market goes up, we'll make some profit. If accordingly the market goes down, we'll lose. Give it a try.
And as I understand it, this is the profit axis of the position, right? And this is the price.
Yes. Yes.
Then what I see here is a small gap, right? So this line doesn't cross at 0 because of the commission, correct?
Yes, that's absolutely right. Yes. Because there are commissions in the market, it turns out that each transaction actually takes a little bit of money and gives it to the exchange. And this is an important factor. We will discuss it in the next lessons.
Yes. Okay, go ahead. I have to click next several times, right?
Yes.
Yes.
Keep pressing down on it continuously. More and more. And even more firmly now.
That is, the P&L is calculated before I even close the position. That means my position is open, right?
Yes. And so you see, it turns out that at the current moment, the last price is below the point where 0 is. That is, it is right here, and you are currently at a loss. This is reflected in the portfolio at the moment.
Yes.
Now you can go ahead and close out the position.
Fine. And that's all. I recorded a loss.
Yes, you recorded a loss because the market didn't go up. And for example, in the spot market, you basically have only one option. That is, you need to guess or somehow analyze when the market will rise and accordingly buy at the lows and sell at the highs. So you only have one option, to wait for a rising market. And the second option is trading futures. That is, with futures, far more people lose money than in this spot market, because the portfolios of long-term investors usually bring at least some returns. With futures, usually about 96%, and if you look at a longer period, say 5 years, then 99% lose their money. And accordingly, what happens here is that futures traders have an added advantage. They can easily short. So for example, you just click long and then say click short. That's it. So we've added, it turns out,
I have a joke from futures traders when I was explaining how options work that you can trade volatility and take positions on both sides. They told me, well, you can do the same thing with futures. Just open two brokerage accounts, go long on one and short on the other.
Yeah, but
Only options traders will get the joke. So, long and short. But I suspect, yes, it should be that way. So, this is not at all what futures traders would expect to see, right? Right?
yeah.
So, this is a guaranteed losing position, right? It's schizophrenic, because in any case, you'll have to pay the commission.
Yes, if you open a long and a short at the same time, in reality, you just pay 2 commissions and nothing happens to you. But with futures, Nikolai, does that mean using leverage? So look, for example, open a short position, for instance, and try to do it. See, we have margin mode enabled, and try, for example, to set 20 times leverage. Let's click through several different individual bars.
Why didn't the P&L move? Anywhere? I would have expected it to drop lower, that my commission would have increased. Because of these quantities, the slope should have changed too. No, why didn't it change?
Maybe you set the 20 times leverage after you clicked short, so most likely, maybe
Maybe, let's try it.
there.
Looks like no. Well, okay, short and click several times, right?
Yes, let's do it. 1. So we lost 1%. 2. Come on, 3.
3. Oh, that was a good one.
Yes, let's go. 4.
4, but I didn't like this one.
Yeah, unfortunately, this one isn't as nice. 5. Yes, come on, 6.
Oh no, this one is really unpleasant.
Can you enlarge the chart a bit, just a little? There will be a directional arrow right here, and you can click on it. Okay, let's do more. So how much? 14%. All right, a little more. More.
So, we're waiting for the account to be liquidated, right?
A couple more times. Well, basically, look, you got lucky, but if you hover the cursor over the P and L, the chart, yes. So your 24 hours are up, and accordingly, a new session has started. It turns out that the scariest thing about futures is that if you open a position with leverage and the market moves uncontrollably against you, then even if your prediction is correct, the market can reach your liquidation point, you get liquidated, and then the market might move in your favor, but you end up earning nothing and are left with a zero balance. Because leverage guarantees the risk of liquidation. So usually, if the leverage is higher than 20 times, then at some point, most traders will be liquidated, simply because there will be a move against them. Excellent. So we've covered spot and futures trading. That is, futures make it easy to trade both long and short, and use high leverage. But the main downside is liquidation. And as a result, you get uncontrolled risk. Of course, you can use stop orders, but stop orders don't always work either. That is, if the market moves very quickly, the stop order can slip. Excellent. And now let's take a look at the instrument we want to discuss today. It's an option. So I suggest we break it down right in the simulator. Press the button, buy call.
With which key? The first one?
The first one, yes.
Buy call.
Yes. And look at what we see. The profit chart looks quite different from what we saw before we had straight lines. There was a straight line like this if we were buying, and a straight line like that if we were selling. So it would go a little up or a little down. If it went up, there was growth. If it went down, there was a decline accordingly. In other words, the changes were linear. Here, notice how interesting it is. There's a fixed risk here. You can move your mouse over there. What does it say there? Cost? Minus?
The total amount is $196.88.
Yes. And notice that if you zoom out the chart a bit, you have unlimited profit. So that's already very nice. It turns out that you can only lose $200, but at the same time, you can earn an unlimited amount of money. But there's a small nuance. Because if this were a perpetual option, then of course, in that case, it would be a tool for making unlimited money. But notice that here there's a label that says TTE. This shows how much time is left until expiration. In other words, the option has a time limit. So this chart that I showed you applies for a specific period of time. That is, if within the specified period the option ends up, for example, in this zone, then you will lose those $200. If, on the other hand, the option goes up somewhere, then you can make a profit.
The spot price.
Yes. If the market, in the given amount of time, moves by the required amount, then you'll make a profit. But what's the best part? The best part is that you can't lose more than those $200. You see? Now try clicking the buy put button. Close this position. Close all. Do a buy put. Look, it turns out you can not only bet on growth, but also on a decline. So it's basically the same thing here. You have a limited potential loss. It's the same $199. But if the market falls within the set time, then you have unlimited potential to earn. For example, if something happens within 24 hours, some kind of super drop, then you could easily make, with these $200, 5 to 10 times your money, maybe even 20, sometimes even 50. So it turns out your options become more flexible. But now comes the most interesting part. Look, you can buy both a put and a call at the same time. And right now you have a put option bought, click to also buy a call option. And this is that very position in both directions. So it turns out that you can at the same time without knowing the direction. But if you know that some important news is coming out, for example, that Trump will announce he intends to start another conflict with some country, then you understand that the market could suddenly drop sharply. Or on the contrary, if he says that today he's in a good mood and will make peace with everyone, then the market will go up. So it turns out that you don't know for sure, but you do know that there will be some speech today. And then you can open this kind of position, which works in both directions. And it turns out that this kind of position, for example, on futures and on the spot market is no longer possible. And the second option, for example, 90% of the time, markets usually move sideways, meaning they don't really move. So it turns out that if you trade, for example, futures or the spot market, then most likely it will be hard for you to make money in such a market because it doesn't really go anywhere. Now try to clear all your positions and simultaneously sell a call and sell a put at the same time. Click sell call and sell put. And look at this interesting situation. So if the market doesn't go anywhere during the specified period and stays within, basically from here to here, then you'll simply get paid because the market didn't move.
And
this is just fantastic for those who trade futures. It turns out that options become a much more flexible tool for forecasting. And so you have not only up, not only down, but you have up, sharply down, or it won't go anywhere. It might go somewhere, I don't know where, but strongly. So it's like a constructor that actually allows you to make absolutely any kind of forecast. And most importantly, with options, you can determine your risk in advance. So, for example, if you look here right now, you can see that the lines are going down. The red lines. If you zoom out, you can see that they go off into infinity. But for example, if you click a few buttons, also, look, the market is going down and you're worried. Wait, don't rush. You're worried? What if it drops sharply? And for example, you don't want to lose more than a set amount. And click here. Buy option port. Do you see what happened? So here is what has happened in this situation. You successfully managed to limit your potential for loss. And now, even if the market keeps going down endlessly, your total risk exposure has been, accordingly, clearly defined. And since the market has already stayed flat for a bit and we've already made some profit, it turns out that now we've closed off the risk of further decline. So if we keep clicking further, and let's say the market moves against us, upwards, just a little more. There you go. For example, click here to buy an option. There you go. So now it turns out that we have... By the way, why did that happen? Why did the whole structure go into the negative? Because you bought a call option at the moment when the market was right on the edge. Do you understand?
so
If you had bought it when it was in the middle, or for example when the position was already showing some profit, then we would have had a position that would have given us the maximum profit right here. And accordingly, here it would give a small profit, but not as much. So you see, we have the ability to open any position with absolutely any leverage, but at the same time with strictly controlled risk. That is, if we have, for example, $100,000, we can easily put all $100,000 at risk, but at the same time not be afraid of being liquidated. So if our prediction turns out to be correct, we can earn a lot. For example, look. Let's say, for instance, we clear all positions. How much time do we have left until expiration? 19.
For many long and tedious hours.
So if you take a look at this, we actually have data showing that this specific option costs exactly 0.2% of the total. That means, for example, right now we can easily buy 100 options for 20% of our capital. Yes, you can set the percentage risk and make it 20%. And then, for example, let's think about where it's going to go.
Let's do it.
Let's take a risk that it'll go somewhere, but we don't know where. Let's buy both a call and a put. Yes, yes. There you go. And let's click on extra ZOC. Alright. Zoom out so we can see where it ended up. And pay attention. Look, we still have 14 hours left until expiration. And right now we already have a 16% profit. Now move the mouse over here. See, we have a clearly defined risk. That means we can't lose more than 20% under any circumstances. You get it, right? And it turns out that if the market, for example, keeps going up, then we'll have even more profit. But we can do the following. So as not to take unnecessary risks, since the market has already moved somewhere, I suggest we sell half here. So set it to 10, set the quantity to 10. And click. Sell call 10. So since the market has gone up, we're going to sell half of the calls now. Do it.
Sell quantity, yes.
Yes, yes, everything's fine, everything's good. Look what happens, see? This area here has moved up.
Now it should be less, down to minus 10%, right?
Yes, because we sold calls at that moment. If we, for example, let's sell 5 more calls.
Once the value reaches the number 5 right here, you will notice that this line will begin to curve and bend even more distinctly than before. Sell, call, right?
Yes.
Then we have 5 here. No, 8. For some reason, it's still 8.
That is mainly because the available options have become considerably cheaper. So we are currently selling a slightly smaller amount overall. So what we can do is the following. That is, if we've already made a profit, we can partially adjust it. And notice that we still, for example, if the market suddenly drops sharply now, we can also make money on the downside. Because you see, the loss range here has become so small. And at the same time, if the market, for example, keeps going upwards, yes, our profit won't grow as quickly, but still, everything will be pretty good. Let's try selling a little more. Let's try selling 3 more options.
Sell, cool.
Yes.
That sounds absolutely and perfectly fine to me. All right.
And 3 more. Let's try to raise this red one so that there's no red left at all. More. There. Look. Now we have quite an interesting position. So it turns out that we raise this point, we raise this point, zoom out. And basically notice that the market would have to do something impossible for us to end up with a loss. And let's see what happens. We have 14 hours left until expiration, so let's press the next button a few more times. Okay, keep going. Oh, okay. Look, it seems like it landed right on target. Ah, no, we're still up 13% by the way. By the way, that's interesting. Let's do it again. Looks like the market was really volatile that day. Next.
Right up to expiration, right?
Yes. And now, let's note that thanks to what we did, in other words, if we hadn't locked anything in, we would have lost about 20%. Because we raised that point, things turned out much better for us. And at one point, we could have locked in about 30% to the portfolio. So it turns out that you have the ability to trade at any speed, but at the same time, you know your risk exactly. That is, for example, you don't have to keep the entire amount on a crypto exchange or any other options exchange. You can, for instance, deposit $100 and keep $2,000 in the bank. And you can fully use the $100 trading with a $20 risk per trade. And as a result, you don't need to keep all your money there. If everything is going well for you, you can simply withdraw your profits. If, on the other hand, you are losing, you can transfer funds from the bank, add more, and in this way, you can simultaneously earn interest on your deposit or on bonds. And at the same time, you can also earn returns from the exchange, and for example, from such a SAI. With the spot market, you can't do that. You either have to use leverage, which immediately brings the risk of liquidation, or you have to keep the entire amount on the exchange, and then there's the risk that if something happens, you could lose it. With options, that's an advantage. It's wonderful. So we've covered another advantage. You can trade with a small amount while keeping the main sum somewhere safe. So it turns out that this results in much more versatile and adaptable trading. We can trade in a sideways market. We can trade when the market is very volatile. We can trade when the market is rising sharply or falling sharply. And we can even, for example, make trades where you think the market won't go up. That is, for example, try to make a sell.
Call.
And you see what happens. What happens is that if the market doesn't go up, then accordingly you receive the specified amount. That is, it might not move anywhere at all. It might just stay where it is. And then accordingly, you get this profit.
Yeah, right.
If
it moves sharply upward, then we'll end up losing our shirts.
Yes, but if it moves sharply upward, you could in theory lose an unlimited amount. But as I said, as we discussed in previous scenarios, you can always cover yourself with a slightly higher option, your risk. That is, for example, you can buy another option if the market goes up, and then your risk will be covered. You get it, right?
Yes. Well, yes, there's always that possibility, but right now it's not implemented in the simulator, though it is available on exchanges. You can cover this short call with an out-of-the-money option.
So options are basically a kind of constructor made up of an infinite number of call sales or call purchases, and it's the same with put options. So in this way, you can combine them in any variations, and you'll get those very option positions that are hard to explain in textbooks. Spreads, strangles, straddles, and so on. But in fact, all of this is essentially just a combination. And the simplest explanation of what a call option is or what a put option is, let's take a call option. You buy it if you think the market will go higher, above a certain value. By a specified point in time? Yes, so let's go through all the positions one by one. So here you have a buy call. That means you believe the market will go above the specified value. And the more it goes up, the better. If you sell a call option, then you believe the market will not go above the specified value. This value can be any value you choose. That is, you can select it, for example, at the current moment. If we had a more advanced simulator, a more sophisticated version, then it would be possible to. You can set it to whatever point you believe the market won't go above. Next, let's look at a put option. If you buy a put option, that means you believe the market will go below the specified point. If you sell a put option, you believe the market will not go below the specified point. And accordingly, next, for example, we have buy straddle, sell straddle. These are already combinations. So if you believe that the market will go either above one specified point or above another specified point, then you buy a combination of a call option and a put option.
If it drops sharply upward or sharply
drops downward, yes. And if you think, for example, that the market won't go anywhere, then you can take the approach that you believe it won't go above a certain point and won't go below it either.
And
that's such an interesting variety of options. And now, let's get to the most interesting part, so we can reinforce all this in practice. Let's try to spend a little. Look, every option has a lifespan during which it exists. In this case, we're looking at daily options, which exist for 24 hours. And here it says that there are 24 hours until expiration. So let's try to forecast the market and accordingly do some trading.
Well, I see the option premium. Do you want me to do it?
Yes, of course.
The current option premium levels are high, so I would sell a short straddle strategy.
Let's try to sell a straddle.
For how many? For one?
Yes. So you think that basically the market in the next 24 hours won't go beyond this range, right?
Well, it's hard to say because I would also look at the daily candle aggregation and try to make some kind of forecast based on coffee grounds from it. But since I'm only looking at the last 24 hours, I'm focusing only on the main option premium. So yes, I think that nothing will happen in the next 24 hours.
All right. Then let's start clicking.
Although maybe it's just an illusion of scale.
Maybe, of course, yes. I mean, we have 24 candles ahead of us.
Yes.
All right. So,
The option premium has dropped. It's already becoming, well, nothing scary.
no, actually, for the portfolio, it doesn't change anything at expiration.
My position was fixed at the moment of opening about 3 hours ago.
Yes, for example, if let's say the market hasn't moved anywhere in 4 hours, you'll already have some profit because you've accumulated option premium you can close earlier.
We are all just waiting, feeling afraid, and simply waiting. Oh, I feel such a deep sense of fear.
We have 16 hours left. That's all that's left.
Nerves are stretched like strings. Oh, another 10 hours. I'm thinking, what if in the last hour it suddenly jumps by 6%? Yes?
Anything can happen, you see.
It's already starting. Yeah, well, actually, I can see the market is already starting to swing. I would have already closed, made 400 bucks, and been satisfied.
Close it. Come on.
All right, let's get it done. Yeah, come on. And let's see. Yeah, let's check out of curiosity what happens next.
Let's do it.
1 and 2 and then 3. Well, actually, I closed at the right time. Yeah, probably in
In general, nothing has changed.
lucky.
All right, let's move on. Here's the next day. You also need to make a prediction for the next day. By the way, you can zoom out the chart a bit to get a sense of the range it's moving in. So if you hover here on the axis at the bottom, you can...
Yeah, you can.
Yeah.
Still, it's not really clear what's going on, and
Then you try out various different option positions and carefully observe what specific range of outcomes they give you.
I have a strong feeling that today is going to be a very quiet, peaceful, and incredibly calm day. Cheap options. And by the way, I have percent of equity, and I bought last time too. Maybe it wasn't very profitable because if you're selling, it's better to use margin.
That is correct, which we will cover in our upcoming lessons. For now, let us try not to complicate things.
Well, let's say then I want to open this kind of position. I feel like there will be some movement.
Go ahead.
Go ahead. Look, it is finally moving. It's moving. It's 7 p.m.
And you see, it's interesting how the market has shifted. And it turns out that it's not so bad that it's in the loss zone at expiration.
But since there's still time, the options are already worth something. By the way, nothing is stopping you from partially locking in profits if, for example, the market. But I only have one contract.
So you can set it to exactly 0.5.
Yeah, okay. But I'll probably be greedy and close it. Cleanup day. No, it came back. Ah, yes, it came back.
See, everything came back exactly. Let's try again. What do you think for the next day?
I think I'll bet on a strong move again.
Let's give it a try.
And right now, I would already be satisfied. 0.5% in a day is good. I would have closed everything already.
Yeah, but yesterday you lost one, I think?
One? So are you suggesting this? Double up? Well, okay, let's double up and see what happens next. Anything above 1, you can exit. You know what I would do, just so it wouldn't feel bad? I would probably close part of the 6 positions. I would now my 4, so what do I need to do now? Right now, I have a long straddle. I need to, like, sell, suffer, do it. Yeah, to close it.
No, you only need to do one thing, sell. So your straddle is a buy call and a buy put. You need to,
It went down, right? So now I need, if I'm selling 0.6, that's the put, right?
yes.
All right, let's do it then.
You just, did you press the button?
No, I haven't pressed it yet. Now I'll press sell put. There, yes, that's how it looks now. All right, let's take another look. It's going back up. No, I really don't care for it. How much does this cost?
Time is left until expiration. Still 9 hours, 8.
Yes, that's right. 8 hours. Come on, give me the line. Give me the NASA trend on the line. Well, it'll just stay like that. Still just a percent. I would sell another 0.2 put.
Please, go ahead.
The put there, it's done. Right here, oh, that is actually quite good. And let's set it for 3 hours. That should be fine. Not good. So, and how can I check what's not just for the last day? How much did you get?
Hey, take a look. Scroll down just a little bit further.
There are trades here.
Right? Yes, you have trades. And as you can clearly see here, because we initially started out trading with such very high leverage in the beginning, you can observe how the chart swung a lot during this period. And because of those dramatic fluctuations, all of the other subsequent trades now seem kind of insignificant or relatively minor in comparison. I would actually suggest that we adjust our approach to make it much better for the future. Statistics, make a reset and make a couple more transactions from the very beginning.
Okay, go ahead. Reset.
Yes.
No chart, didn't load. And where?
Schedule? Let's open the chart again. Maybe he didn't like something. I'll try to do a zoom out. Maybe it's not the schedule that didn't load, but
I see aggression. Okay, this is 24 hours. All right, let's fast forward to expiration to 0. We started, and it turns out there were green candles. I can't even see where this is, where the day markers are. So basically what happened on previous days, in other words, this is really playing blind. So what can you even rely on here? Just intuition?
no, we have the average, we have volatility, the cost of options. There's much more than just intuition here.
Well, okay, but I see the average. And remind me, when it comes to averages, they tend to bounce down after such movements.
If averages are trending, when they're flat, price often crosses and fluctuates around them.
Got it. That's why I want to sell a straddle.
Go ahead.
Assuming nothing will happen. However, that is not the case on the second one. It is exactly 1. And the margin is perfectly correct. So if we really stop to look at it this way, when I am dealing with a straddle strategy, my only real hope for success is just to sit back and wait for a big move. Wait for expiration, right?
No, you can also close it early, that's fine too. So, for example, if it stays in place for 5 hours and you've already accumulated some profit, you don't have to wait any longer. Or you can even, for example, average down. That is, if it goes down, you can sell more puts there, and if it comes back up, you'll make even more.
Right, if it goes down, sell puts.
Yes, sell another put. And if the price happens to bounce back up from here, you can, for example, choose to buy at this level, and then this specific part of the chart will simply go away for you. Some kind of...
It's already a whole mountain. So it turns out in the city, the harvest is like this. Well, okay, we're waiting for 900, right? That is, now it's returning to the average. So it turns out that because of this movement, I just shifted this, how to say, this part.
That's how I lifted the center as well.
Yeah, and you lifted the center perfectly and correctly. And now the put has settled down into place as well. The put settled down correctly and everything. A little more. Now maybe we have 12 hours until expiration. Oh, here you can
Now buy back the put that you sold earlier.
now buy the put.
See, the zone has become even wider.
Yeah, right. And what does the portfolio look like in this case? Well, yeah, of course, it's hard to imagine all this in your head.
Well, of course, yes.
Yes, no, but on the other hand, here's the chart, right? Here it is. There's a chart. Interesting.
The chart, most importantly, shows everything. You can see exactly where you'll have profit and where you'll have loss.
Well, 1% in a day, I think that's very good. I would even say 1.5% in a day. And
How much time is left until expiration?
10 hours. So I'm feeling a bit anxious about it. But still, that's a whole percent in a day.
Well, it's up to you. No one is forcing you.
All right. I can't handle any more trades today. My nerves are completely shot and I'm finished.
All right. Let's check later.
8 hours. You can hold on until 8 hours before expiration.
All right.
That's it. I'm off to bed. Let's see what happens. The price here was $2,500. Oh, wow. I mean, that was a really unfortunate mistake. 2,500. Honestly, yeah, that was a really terrible move.
Well, yeah, most likely you would have ended up at break even, although for now,
Yeah, you would have been right on the edge, most likely.
yeah.
It was the right decision to lock in the profit.
And if you take a look right over here, any trading consists of three basic elements: forecast, instrument, and risk management. And let's do the last trade by the rules. So first, make a forecast. Say, for example, I believe that in the next 24 hours the market will do this, this, or this. It will stay in place, move sharply up, move sharply down, or something else.
I think it will stay in place.
You think it will stay in place? Excellent. So in that case, we can sell both calls and puts, or simply sell a straddle, which is essentially a combination of a sold call and a sold put.
All right, yes.
Good. Excellent. And don't forget, now another question. How much are you willing to risk? So, in your simulator, how much money do you have?
That would be 101,000.
101,000. How much will you earn if the market stays exactly in place as shown?
Okay, let's see. Plus 2,000. 600.
Plus 2,000. If the market, for example, moves sharply in some direction, how much could you lose?
Infinitely.
Of course, if you zoom out the chart, the approximate boundaries will still be more or less clear. Well,
How much is that 5%, for example?
I mean, take a look at this. How exactly do you go about figuring out where it might go? I mean, by carefully zooming out on the chart to look at what happened on previous days. So it's clear that in 24 hours, it's unlikely to move that far, or for example, the same distance downward. So basically, you could probably lose about 4,000 or 5,000 there, right?
Well, probably.
All right, that's it, let's go. So the risks are more or less clear. I hope you're comfortable with those risks. In
the sense of making 2.5 while risking losing 5?
Well, that is certainly true and to be expected, but if you take into consideration the fact that in more than 80% of these specific cases absolutely nothing of consequence ever happens, then you will realize that the situation is actually not nearly as bad as it might first appear to be.
And
see, that's the good part. If for just 1 hour nothing happens, you're already in the plus. And that's really nice.
the mechanics are that I opened a short position, right? This straddle, the option premium, it drops, and that's why I'm actually in the plus.
Yeah.
It's only truly good. Oh, how incredibly good. Oh, it's just so very good. Oh, you know? But it's scary.
Of course, sellers are always more afraid than buyers.
But here, so it's 2000 until the 24th, but I've already waited half the time and it's 0.77. I'm trying this out on the market and I'd already be scared. So I would already be satisfied with these levels. But how do you know if that's enough for me or not?
There's no way to know. It's only your own internal feeling.
So I just sit and keep waiting.
Or you close the position. You can close the position. You can always close half the position, for example.
All right, half the time has already passed. That's a good result. Let me close half. Sell straddle.
Yes.
Sell straddle. Oh, that's a relief. So it's really not as deeply distressing anymore.
Oh, wait a second. That's not right. You just increased your position. You had a straddle.
Oh, right, I need to buy. Oops, wait. So actually now it's scarier for me. So that means for me. Now I need to buy, right? Did I sell 1.5? Yes.
Yes.
That's it. Oh.
See, you can see it already feels much better.
Yeah, so, oh man, it is just so incredibly scary. Oh, it is really scary. So I am wondering, how exactly do I go about raising this specific part up right now?
To raise this part, you need to buy a few call options. So if you have half left, you can buy, say, half, 0, buy 0.2 call options, and it will raise it a bit.
And call options should be just super cheap right now, right?
But there's hardly any juice left until expiration, basically until 9.
Several hours.
He could buy a few options on the fly. Cool.
Everything has calmed down a bit. It's passed.
All right.
Our finger twitched. So
it would be good to get a bit closer down there, right? That would be just
great. Yeah. Go ahead. I need this machine to go straight down the line. There. It's moving well. I really like it like this.
all right in the very center. I think here you might not even need to wait the remaining 3 hours. Well, it's up to you, of course.
No, I don't want to wait. Close it, right?
Yeah, close it. That's it.
Let's see what's going on here.
See what a wonderful... Yeah, let's watch the last 3 hours. Yeah, you see, it moved away from that central zone.
Yeah. That's all. All right.
So, my friend, let's sum up today's results. What do we have? First, with options, the risk is controlled. That is, we can create positions with controlled risk, plan our strategy in advance, and actually leave, go to bed, and sleep. In other words, it's not necessary to manage the position throughout the day. So, if we've set up and defined the risk in advance, that's it, we can just go about our day and relax. Second, options allow you to make big multiples. In other words, we can buy a large number of options with a predetermined risk, and we can risk our entire deposit without fearing liquidation, unlike with futures. This is something you can't do with futures or on the spot market, because if the market moves against you there, you can be liquidated instantly. Then, for example, the market might move in your favor, but in the end, you'll be left without a position. The third advantage of options is that you can trade in any market. That is, you can create positions for a sideways market when nothing is happening, or for a market that's moving a lot, but you don't know in which direction. So, we get this additional dimension. In other words, we can not only predict the direction, but also the speed of the market. So, for example, if the market is moving quickly, we can earn more if we can predict this additional parameter. So it turns out that this is an interesting kind of constructor that gives much more flexibility compared to futures and the spot market. And accordingly, that's exactly why I recommend options to those who have already gotten burned on futures. In reality, not that many people get burned there. They can often sit in a position for a long time if things go the wrong way, but fortunately, everything is a bit calmer there. And these are the kinds of opportunities that options provide. And most importantly, you can make good money even with a small amount of capital, because it's not at all necessary to keep the entire sum on deposit. You can keep most of it in some safe instruments. Next, we'll go over what you need to pay attention to when trading options, which positions are suitable for different types of markets. And accordingly, in practice, using a simulator and in real trades, we will analyze how you can earn money with options. That's the end of today's lesson. Thank you to everyone who watched this video to the end. We would appreciate it if you give us a like, leave a comment, or subscribe to our channel. This was Roman and Alex with you. See you again on our channel. Goodbye, everyone.
Bye, Roma.